What's really going to happen to our property markets? Are rising interest rates really going to strangle our property markets, or are we going to have a more subdued fall? In today's Property Insider video, Dr. Andrew Wilson explains his predictions for the balance of 2022, and we also talk about the good and the bad side of low unemployment rates. If you'd like to keep up to date with what's happening to our property markets, please subscribe to this YouTube channel and click the little bell icon so we can update you every time a new show comes out. What's really going to happen to our property markets now that the unemployment rate is so low? Unemployment fell to a 48-year low at 3.5%, when 88,400 people found work last month in Australia's increasingly tight labour market. In fact, it's now got one job seeker for every job advertised at present. But while some may see this as a good thing, the stunning June jobs data all but guarantees that the Reserve Bank's going to lift interest rates by, well, at least 0.5% again in August, and some economists are tipping a 0.75% increase. Now, this has caused the Financial Review to run a clickbait headline saying this will be a knockout blow for our housing markets. Now, I don't agree with these forecasts, but the low unemployment rate could have some unpleasant knock-on consequences. Anyway, in today's Property Insider video, Dr. Andrew Wilson explains what happened to our property markets in the past, which should give some background to the forecast he's going to make for where property values are going to end up at the end of 2022. Considering his track record, Andrew Wilson, Chief Economist of My Housing Market, is somebody worth listening to. Hi, Andrew.
Yes, hello, Michael. And it's a real good news, bad news story environment, isn't it? We are being inundated with lots of bad news. I'm not quite sure it's credible bad news, but it seems the Reserve Bank's on the bandwagon as well. So I guess they'll take that usual road to Damascus that all those negative doomsayers traditionally take following the revision of the particularly forecast for house prices. But we had a fantastic result in terms of the labour market last week, of course. The unemployment rate for June fell to 3.5%. But it is a good news, bad news story, because that's probably, in terms of policy, the last thing the Reserve Bank wants to see, because really the only signs of success, or the real sign of success for the Reserve Bank, will reflect higher unemployment rates, Michael, and that means we would have been reducing demand, and that's the big game here. Let's reduce demand.
Yes, Andrew, there are two sides to the story. On the one hand, job creation of this magnitude, well, I guess it's a remarkable result. A record high vacancy numbers, rising wages, rising cost of living pressures. I guess that's encouraged lots of Aussies to look for jobs, to increase their hours of work. And I know some are even switching jobs to get higher pay. But this result is going to put pressure on the Reserve Bank to raise interest rates, isn't it?
Well, the main game for the Reserve Bank, Michael, is to reduce demand. And that means they want to see spending reduced. Retail sales are at spectacular levels. They have been since COVID or through COVID as a result of the stimulus packages. And the more people spend in a constrained supply environment, the higher prices go. The higher prices go, the more people will demand higher wages, and they'll be able to get those higher wages because there's such a shortage of labour out there at the moment. In fact, we have amongst just about the strongest labour market we've ever had in terms of the unemployment rate. We are in clearly a booming economy. And this is absolutely the worst conditions the Reserve Bank could hope for when it's trying to reduce demand. Now, demand will only be reduced when people have less to spend, Michael. And they're in an environment now where they have certainly the capacity to spend more, and that enthusiasm will continue to push up prices. This is a real slippery slope in terms of the policy position. And we have got a long way to go and a lot of uncertainty in terms of controlling inflation, Michael. Just absolutely no sign, even though it's early days, that there's been any improvement in the inflationary outlook, although we are starting to see, thankfully, the price of oil now falling. So, but interestingly enough, the price of oil is falling, perhaps because of concerns of a global recession coming up.
Well, you and I have been around long enough to remember the wage price inflation spiral before. And so with the Reserve Bank wanting to dampen employment growth, which I guess means increasing the unemployment rate, that in the past, way back when we were much younger, sent businesses broke. I guess that's what cooling the economy means, doesn't it?
Well, we're starting to see some signs in the building industry, and now a number of builders are under stress. The US had a terrible number on its inflation for June, 9.1%. annual inflation growth in the US, Michael, highest since 1981. Underlying inflation also increased. The dogs were barking that the Fed will increase interest rates by 1% at its next meeting, which is next week. I'm not sure that will happen. There's been some counter data coming out recently regarding inflationary expectations in the US, and they're looking at an interest rate of an official interest rate of 4.75% by the end of the year, Michael. So that's another 3% increase in rates by the end of the year in the US. They also have really no sign of improvement in the headline inflation numbers and the underlying inflation numbers. But however, they are starting to see some early signs that their economy is starting to shift sideways. But they've moved into the higher interest rate cycle earlier than Australia. The other point to the unemployment data, Michael, I thought was interesting was we had the record low unemployment rate, but we have a record high participation rate, which means we're drawing the highest proportion ever of our population into our workforce. So we're just really scraping the bottom of the barrel in terms of the labour that is available to us, in a sense, from the population. And of course, the clear exacerbation to this situation of running out of workers is that we've closed our borders to migrants over the last 3 years. Because if we had have had our borders open, we would have had an extra 200,000 to 300,000 workers available through international migrants. And of course, not having that has led to this labour shortage that we have at the moment, which will only fuel higher wages, which will only fuel spending, which will only fuel inflation.
So as I said earlier on, the Financial Review thought the rising interest rates is going to be a knockout blow to the property markets, and the commentators are out there telling us how bad things are going to get. But let's look back in the past so we can get an idea of what's going on. How bad have property falls actually been?
Well, history is our first port of call if we're doing research in terms of forecasting anything, and particularly house prices. If we go back in time and we look at the record falls over a year in house prices, the highest national fall, and that's from December quarter to December quarter recorded in the modern era, and that's since 1987, was 5.5%. And that was in 2018, Michael, where we had similar circumstances to the current circumstances, which was a fear campaign which was sidelining buyers and sellers and impacting confidence. And the highest result we've had on a state basis was 9.9% in Sydney over a calendar year, and that also was in 2018. But of course, some of these predictions cover the peak to trough scenarios. When we look at peak to trough declines in our housing markets, and that's from the peak of the market cycle to where it finally bottoms out. The record peak to trough on a capital city basis, Michael, was between June 2017 and June 2019. So that's a 2-year period. Sydney house prices fell by 18.2% over that 2-year period. So that averaged around 9% per year. Melbourne, its record peak to trough decline was between March 2018 and June 2019. And that was a 14.1% decline. The other major capitals, Brisbane's record peak to trough decline was 7%. Between June 2010, September 2011. Over a similar period, Adelaide's record decline in house prices peak to trough was just 4.5%. And for Perth, its record peak to trough decline was 8.4% between December 2008 and March 2009. So these numbers certainly are not anywhere near some of the forecasts on an annual basis that have been made. This is the historical evidence for us. So it remains to be seen whether, once again, those that are predicting the Armageddon of house price falls will once again prove to be incorrect.
But Andrew, the market's very different at the moment. At those times, we had credit squeezes, we had other economic issues. At the moment, our economy is doing well. Everyone who wants a job's got a job. There are no forced sales. There are no mortgagee sales. So what do you see moving forward in 2022-23?
Well, certainly we have a crisis of confidence evolving, which is what we saw in 2018-19, no surprise. But these things tend to be short-lived, Michael, when people get on with the business of moving house, bigger house, smaller house, move to the beach, move to the bush. And those factors eventually overcome the fear factor. We have a shortage of rental property, which is clearly evident with skyrocketing rents and very low vacancy rates. So that attracts particularly investors to the market. We've got all that demand yet to come through from first home buyers through the extension of the first home buyer deposit scheme. Of course, we're opening borders, so migrants and students coming back into Australia need somewhere to live in an undersupplied market. As you mentioned, full economy. We've got other full employment economy, other supporting factors such as the government welfare handouts announced prior to the election. Record savings. We've got a great position in terms of our assets. We've got a couple of predictions here in terms of where I believe our house prices will find themselves by the end of the year, Michael. Melbourne and Sydney, no surprise, will be the outliers, in my opinion. I think both Melbourne and Sydney will record around about 6% falls in their median house prices over 2022. Of course, they'll still be well ahead of where they were 3 years ago. Sydney would be up still 30% and Melbourne up 20% compared to prices in 2020. I think Brisbane's on track to record 11% increase in the median house price this year. Adelaide up 12%. Perth, which is having quite a sustained revival in its market, I think house prices in Perth will be 9% higher. And if we use a weighted average on all those major capitals, I think we'll end up, the national house price will be just above the line with growth of around about 1% over this year. So still well short of a lot of those predictions, Michael. And in my humble opinion, I don't think we'll be too far away from those results. You've got to understand, Melbourne and Sydney have had an extraordinary period of growth over the last 3 years. They're still well ahead of the mark, even with those projected declines in prices. You know, with all those positives in terms of demand over supply, eventually the fear factor will lose its edge. That's what we saw in 2019, Michael. Even though we had a lot of bad news stories around early in 2019, prospect of tax changes for investors, the Royal Commission into the banking sector, and of course the same hysterical headlines regarding house price crashes at that time. But buyers started to work their way back into the market because they started to, I guess, recognise that there were good value opportunities as a result of buyers and sellers lacking confidence to be in the market. And gradually the market turned early in 2019, even before we had those interest rate cuts at the back end of 2019. So fear tends to be a short-term or shorter-term driver of housing market activity.
Of course, it's got to be remembered there's not one Melbourne or one Sydney property market. High-end properties that led the boom are now coming off the top. And there are going to be some issues in the lower end where wages haven't gone up as much as house prices have. So overall, while the Sydney and Melbourne market is going to drop around 6%, some sectors will drop more and others are going to hold steady, aren't they?
Well, that's right, Michael. And our data is clearly showing that the middle and higher ends of the market are the ones that are leading prices downwards in Melbourne and Sydney, but particularly Sydney. But the budget markets are holding up. And of course, that's because they're driven by first home buyers and investors. And as they have particular incentives to be into the market, first home buyers with the first home buyer deposit scheme, where there are limited places. And of course, investors are chasing those relatively high yields given returns in other asset classes with these very tight rental markets that we have. And I also think it's interesting looking at the Melbourne market, particularly, Michael, that we're seeing a bit of a mini boom in apartments in Melbourne at the moment. So I think there's a sign there that developers sniff the wind and are recognising that there is clearly a shortage, particularly of apartments in that Melbourne market, particularly inner ring suburban markets. I think there's an acknowledgement that there needs, and we know across the board we have a lack of housing in Australia, but I think developers are signalling in Melbourne that they think that demand will continue to override any negativity in the market.
Well, affordability constraints now mean that it's hard to afford a home in the better suburbs of Melbourne and Sydney, and the gap between apartments and houses is the widest it's been for a long time. So family-friendly apartments, not the little shoeboxes, are doing very well. Yeah. Having said that, the auction markets in Melbourne and Sydney are feeling a bit of a winter chill, Andrew.
Yeah, look, that's right, Michael. And look, we're exactly in the middle of winter. And this is the period where the market is at its lowest ebb because of the distractions, particularly of school holidays. We're waiting for the usual revival in spring, the spring selling season, which is now building momentum. We'll be interesting to see if we get a spring selling season this year. But I think that the results aren't spectacularly bad, Michael. I think they're quite, you could rationalise it just on being the end of the boom. A lot of buyers have satisfied their demands. Obviously, affordability barriers are pushing some buyers out of the market. There is the confidence factor with the screaming headlines, house price crash. But we've mentioned all those offsets to those silly headlines. But I think the clearance rates are certainly holding, Michael. The one thing we notice is that auction numbers, particularly in Sydney and Melbourne, although they did pick up on the weekend, but they're well below where they were a year ago. But a lot of what was happening a year ago reflected the return of the market from lockdowns. We're not at this stage anyway looking in just a little bit more than subdued winter market. And I think as long as those clearance rates are holding in the mid to high 50s, Michael, and we're being seduced by 80% clearance rates for a while now, but they're just clearly an aberration and an adjustment from a period of underperformance. I think we'd have to see clearance rates starting to head consistently under 50% for us to realise that there was a real contraction going on in the market. And as yet, we're not seeing that.
Clearance rates are partly holding up because there are fewer properties being put to auction. Yes. In other words, discretionary sellers are saying, hey, why sell at the moment? And right. Sellers are buyers. They'll eventually come back into the market when they're ready.
That's right, Mike. And that's the point with the prestige and middle markets being the underperformers. And that's because they have a higher proportion of discretionary buyers and sellers. So they'll just think, well, things look tough. We're reading these silly headlines. So let's just sit on our hands and see how things pan out. Whereas budget markets tend to be more active. We've mentioned that first home buyers who tend to want to get into the market in weaker periods because there's not as much competition for property. Therefore, prices aren't rising and ahead of their income capacity. Investors, of course, keen to chase those skyrocketing rents at the moment. And the winter market is typically that, Michael. We see a much lower proportion of higher priced properties in the market because that end of town tends to be more discretionary and they're on holidays or they're waiting for spring, whereas we see a higher proportion of lower priced properties because they tend to be the non-discretionary sellers, such as personal issues, shifts in employment driving that. But it is a typical winter market at the moment, Michael. And as yet, we're still seeing reasonable clearance rates in what you could probably still say overall is a balanced market environment.
Well, it'll be interesting to see how things move moving forward because the Reserve Bank's being caught by surprise in a number of ways. Yeah. Inflation's higher than they expected. Yeah. Unemployment is much lower than they predicted only a couple of months ago. So they're going to have to be on their game, and we'll be back each week to report and commentate on what's happening in the market. Look forward to catching up next week.
Yeah, thanks a lot.